Every time a new tax bill comes out, people react the same way, confused, stressed, and sometimes even angry. They worry about whether they'll owe more, whether their refund will shrink, or whether they'll even understand the changes. But here's the truth. Every new bill creates two groups of people. The first group complains, does nothing, and ends up paying more than they should. The second group takes the time to learn the rules, make adjustments, and ends up saving thousands. This latest bill for 2025 is no different. Yes, it changes how your tax return will look, but it also opens up opportunities that most people will completely overlook. And if you're smart, you'll put yourself in the winning category. The people who not only understand the changes, but actually use them to their advantage. In this talk, 8, I'm going to break down what this new, beautiful bill means for you. We'll cover how to learn the new rules before you play the game, how to grab every deduction and credit you can, how to rethink the way you earn and invest, and how to create a year-round tax strategy that keeps you ahead for 2025 and beyond. Learn the new rules before you play the game. Imagine walking into a game of poker where the dealer has switched the rules overnight. You sit down, play with the old strategy you've always used, and before you know it, you've lost everything. Why? Because you didn't realize the rules had changed. That's exactly how most people approach taxes when a new bill comes out. They keep filing the same way they always have, not realizing the system has shifted. The 2025 tax bill has written parts of the rule book. It's not just a small tweak here or there. It impacts tax brackets, deductions, credits, and possibly even how certain types of income are treated. And here's the harsh truth. If you don't take the time to understand these new rules, you'll end up giving away money you could have legally kept. Now, let's break this down. First, tax brackets. This is the big one most people notice. Maybe the thresholds for each bracket have shifted, meaning you could accidentally end up in a higher tax bracket even if your income hasn't changed much. Or perhaps the government has adjusted the rates themselves, lowering some brackets and raising others. If you don't know where you stand, you can't plan effectively. Understanding your bracket is like knowing the level you're playing on. It determines every move that follows. Second, deductions. These are the sneaky game changers. A new bill often adds, removes, or alters deductions. For instance, the bill might reduce the standard deduction for certain taxpayers while expanding itemized deductions for others. If you don't catch that change, you might file under the wrong method and lose hundreds, maybe thousands of dollars. It's like walking past a pile of cash because you didn't realize you were allowed to pick it up. Third, tax credits. Credits are the goldmine of the tax world. Unlike deductions, which just lower your taxable income, credits directly cut down the amount of tax you owe. This new bill may have created fresh credits for families, education, energy efficiency, or even small businesses. But here's the catch. Most people won't even know they exist. They'll file the same way they always have, never realizing they could have reduced their tax bill dollar for dollar. That's like playing Monopoly and not knowing you could collect 200 every time you pass go. A fourth, filing requirements and thresholds. Sometimes bills change who has to file, what forms you need, or what income levels trigger certain obligations. If you don't know these updates, you could miss deadlines, file the wrong forms, or get slapped with penalties. Not because you didn't have the money, but because you didn't know the rules. Here's the reality. The tax code isn't designed to be friendly. It's long, complicated, and full of technical language that puts most people to sleep. That's why the majority just throw their documents into a software program or hand them to an accountant and hope for the best. 8. But that's not a strategy. That's crossing your fingers and praying. If you want to win, you've got to at least learn the basics of the new rules. You don't need to memorize the entire bill, but you do need to know the parts that affect you. That means asking questions. Did my tax bracket change? Are there new deductions I qualify for? Have credits been added that apply to me or my family? Did the reporting rules for my side hustle change? By answering these, you're already way ahead of most people. And here's the kicker: the government doesn't care if you don't know. Ignorance isn't an excuse. If you overpay, they won't call you up and say, "Hey, you gave us too much, here's your money back." If you miss a deduction, they won't politely remind you. The system is designed so that only the people who pay attention reap the benefits. Everyone else funds the pot. Think of it like this: when you play chess, you don't just move pieces randomly. You study the board. You know which moves are legal, which ones are powerful, and which ones could trap you. Taxes work the same way. If you study the new bill, even at a surface level, you're not wandering blind, you're playing with strategy. The good news: learning the rules is easier than you think. There are breakdowns online, summaries in plain English, and even free webinars explaining the changes. Spending just an hour to familiarize yourself could save you hundreds or even thousands when tax season comes. So here's the bottom line: if you don't know the new rules, you're not even playing the right game. The 2025 tax bill has changed how the system works, and those who take the time to understand it will win. Those who don't will lose, and they won't even realize how much until it's too late. Grab every deduction and credit available once you've taken the time to understand the new rules of the 2025 tax bill. The next step is simple: grab every deduction and credit you can get your hands on. This is where most people leave money on the table. 8. They either don't know what's available, they assume they don't qualify, or they can't be bothered to keep the records. But here's the harsh reality: every deduction and credit you don't claim is like writing the government a donation check you never meant to write. Let's break down why this matters. Deductions reduce the amount of income you're taxed on. If you earn $70,000 and you've got 10 zeros worth of deductions, the IRS taxes you on 60,000, not the full 70,000. That's huge. It lowers your taxable income, which could even bump you down into a lower tax bracket, saving you even more. Credits, on the other hand, are even better. They cut your actual tax bill dollar for dollar. If you owe $2,500 in taxes and you qualify for a $11,000 credit, your bill drops to $500. That's not theory, that's real money you get to keep. Now, here's where the new bill comes into play. Every time lawmakers pass a major tax reform, they adjust these deductions and credits. Sometimes they increase the standard deduction, making it easier for people to claim without itemizing. Other times they add or expand credits for families, businesses, or specific behaviors like going green or saving for retirement. If you don't pay attention to what's new in 2025, you'll miss out. Take families, for example. Big tax bills often adjust child tax credits. The 2025 bill might increase the amount parents can claim per child or expand income limits so more families qualify. The 48. If you're a parent and you don't know about this, you could miss out on thousands of dollars just by ticking the wrong box. Then there are education deductions and credits. If you or your kids are in school, new rules could allow you to deduct tuition, textbooks, or student loan interest. These are expenses you're already paying. Why wouldn't you turn them into savings on your tax return? Yet, so many people skip this because they don't track the expenses or don't realize they're eligible. Healthcare is another area that often gets updates. The bill might expand which medical expenses qualify as deductible. If you've spent thousands on out-of-pocket costs, prescriptions, or treatments, you could potentially lower your taxable income significantly, but only if you've kept receipts and know the new thresholds. Homeowners also need to pay attention. Governments love to incentivize people to make their homes more energy efficient. That means energy-related credits for installing solar panels, upgrading windows, or even buying electric vehicles. These aren't just small perks. Sometimes these credits can slash your tax bill by thousands. Imagine upgrading your home 8, saving money on your utility bills and then having the government reward you at tax time, that's a triple win. And let's not forget business owners and side hustlers. If you run a small business, freelance, or even have a part-time gig selling online, the new bill could change what you can deduct. Things like equipment, mileage, home office space, or even certain travel expenses might now be deductible or expanded. If you don't claim these 8, you're working harder than you need to because you're paying tax on money you didn't actually get to keep. Now, let's address the elephant in the room. Most people don't bother. They rely on their tax software or accountant and assume everything's handled. But here's the problem. Software only works with the information you give it. If you don't know to track an expense, save a receipt, or check if you qualify, it won't magically fill in the blanks for you. And while accountants are helpful, they can't invent deductions out of thin air. You need to bring them the raw material. This is why planning throughout the year is so critical. Don't wait until March or April to start digging through drawers for receipts. Keep records as you go. Track your expenses in real time. Stay updated on what's deductible under the new bill. That way, when tax season rolls around, 8, you're not scrambling. You're ready to claim everything you deserve. Think of deductions and credits as coupons for your taxes. Imagine walking into a store, filling your cart, and then throwing away a stack of 50% off coupons at the checkout. That's exactly what most taxpayers do when they ignore deductions and credits. They pay full price when they didn't have to. The bottom line is this: the 2025 tax bill has introduced changes that can either hurt you or help you, depending on whether you act. If you take the time to identify and claim every deduction and credit available, you'll legally cut your tax bill, keep more money in your pocket, and put yourself in a far stronger financial position than the average person. So don't let laziness or ignorance cost you. Be proactive. Hunt down every deduction, claim every credit, and make sure you're not one of the millions who unknowingly overpay. Because in this game, the winners aren't the people who earn the most. They're the ones who know how to keep the most. Rethink how you earn and invest. One of the biggest mistakes people make when it comes to taxes is treating them as something that only happens once a year. They think, I'll deal with it in April. But the truth is, taxes are tied directly to how you earn your money and how you invest it throughout the year. If you don't rethink your income and investment strategy in light of the new 2025 tax bill, you're leaving yourself exposed. Here's the hard reality. Not all money is taxed equally. A dollar earned from a paycheck isn't the same as a dollar earned from investments. The government doesn't treat them the same, and once you understand the difference, you can position yourself to legally pay less and keep more. First, let's talk about how you earn. Most people rely on traditional wages, money from their job. That's the highest taxed form of income. You work, you get paid, and the government takes its slice before you even see the money. That paycheck is getting taxed at ordinary income rates, which can be brutal depending on your bracket. But here's where things get interesting. The 2025 tax bill might shift the brackets, introduce new rates, or adjust thresholds. That means your job income could push you into a higher tax band faster than you realize. If you don't rethink how you earn, you could watch more of your hard-earned money vanish. So what's the alternative? Diversify your income streams. Side hustles, small businesses, and freelancing not only bring in extra cash, but they open the door to deductions and business expenses. That laptop you bought for work, that home office space, even part of your internet bill, all could be deductible. Suddenly, the money you earn this way is taxed differently. Instead of just losing a chunk to taxes, you're reducing your taxable income with legitimate write-offs. Next, let's talk investments. This is where the smart money plays the long game. The tax code has always rewarded people who put their money into assets that grow wealth rather than just relying on a paycheck. capital gains, dividends, retirement contributions. These are taxed at different rates, often lower than ordinary income. For example, capital gains on investments held longer than a year are usually taxed more favorably. So, if you're investing in stocks, real estate, or other assets, the tax you pay on those profits could be much less than what you pay on your regular paycheck. The new bill might tweak these rates or thresholds, which could create even more opportunity or risk. For investors who aren't paying attention, think about retirement accounts too. Contributions to plans like a 401k or IRA often reduce your taxable income today while allowing your money to grow tax deferred. The 2025 bill could raise contribution limits or expand eligibility, meaning you can stash away even more and cut your current tax bill in the process. Yet most people never max these out, leaving both growth and savings on the table. And then there's the rise of tax-advantaged accounts for things like health savings AHSAs or education savings 529 plans. These accounts often come with deductions, tax-free growth or tax-free withdrawals for qualified expenses. If the new bill sweetened these benefits and you ignore them, you're missing one of the easiest legal tax shelters available. Now, let's zoom out. Rethinking how you earn and invest isn't just about saving money on this year's tax return. It's about building wealth strategically. If you earn purely from wages, you'll always be at the mercy of the tax brackets. But if you structure your income so that more of it comes from investments, tax-advantaged accounts, or business activity, you gain control. Here's a practical example. Imagine two people both make $80,000. One earns all of it through a job, no side hustle, no investments. The other makes $60,000 from their job, $10,000 from a side business, with deductions lowering taxable income to $5,000, and another $10,000 from long-term investments. The second person's tax bill will often be lower, even though their total income is the same. Why? Because they restructured how they earn. This is exactly the kind of thinking the 2025 bill demands. New rules will create winners and losers, but the winners will be the ones who adapt. Don't just ask, how much did I make? Ask, how did I make it, and how is it taxed? That question can be the difference between losing thousands to the IRS and keeping thousands to grow your wealth. Finally, remember this: money that's invested smartly doesn't just protect you from taxes, it builds freedom. It compounds, grows, and eventually works harder than you do. Every dollar saved from taxes and invested wisely is a soldier fighting for your financial independence. So, as the new tax year approaches, don't fall into the trap of working harder for the same results. Rethink how you earn, rethink how you invest. Use the tax rules to your advantage. Because in the end, it's not just about making money. It's about keeping it, growing it, and putting it to work for you instead of handing it over to the government unnecessarily. Stay ahead with year-on planning. Most people only think about taxes once a year, right before the deadline. They scramble through receipts, stress over forms, and then promise themselves they'll be more organized next year. But of course, next year looks exactly the same. This last-minute approach is why so many people overpay and miss opportunities. The truth is, the people who win the tax game are not the ones who panic in April. They're the ones who plan year-round. Think of taxes like fitness. You don't get in shape by going to the gym one day before a beach holiday. You stay consistent all year. Taxes work the same way. If you want to save money and take advantage of every break, you need to set up habits and systems that keep you ahead, not scrambling. The first step to year-round planning is tracking everything. Most people don't even know where their money goes. They swipe their card, pay their bills, and then at tax time try to piece things together. That's a recipe for losing money. Instead, get into the habit of tracking your income, expenses, and investments throughout the year, whether it's a simple spreadsheet, budgeting software, or even an app. This habit ensures you never miss deductions or credits because you forgot. For example, let's say you start a small side hustle. Maybe it's selling items online or freelancing. If you don't track your expenses during the year, you'll forget about that software subscription you paid for, the internet portion you used for work, or the mileage from meeting a client. Each of those missed items could have lowered your taxable income. Yeah, round tracking ensures you get credit for every penny. Next, adjust your strategy as the year unfolds. The 2025 tax bill may have changed brackets deductions or credits, but those changes don't just matter on April 15th, they matter every paycheck. If you're earning more and pushing into a higher bracket, you may want to increase your retirement contributions now to lower your taxable income. If you've had a year with less income, maybe you take advantage of tax harvesting by selling some investments at a lower rate. The key is to make moves as the year goes, not after it's too late. 8. Another critical part to year round planning is keeping up with ongoing changes. This new bill won't be the last. Governments are constantly tweaking the rules, sometimes mid-year, staying informed through financial news, newsletters, or even working with a tax professional means you can pivot quickly. Imagine finding out halfway through the year that there's a new credit for energy efficient home upgrades. If you're in the loop, you can make the purchase and benefit. If you're not, you only learn about it when your neighbor brags about saving thousands. Now, let's talk about automation. The best way to stay consistent is to take the decision making out of your hands. Set up automatic transfers into retirement accounts. Automate savings for potential tax bills if you're self-employed. Automate charitable donations if you plan to itemize them. Automation ensures you're building a tax-efficient lifestyle, not relying on willpower or memory. One of the most overlooked parts of year-round planning is quarterly check-ins. Every 3 months, sit down and review how much income you've earned, what your expenses look like, what investments you've made, and how the new tax rules might apply. This doesn't have to take hours. Even 30 minutes every quarter can save you thousands. You'll spot patterns like realizing you're on track to hit a higher bracket and need to adjust, or that you haven't used available deductions yet. And here's a mindset shift that separates the winners from everyone else. Stop seeing taxes as a once-a-year burden and start seeing them as part of your wealth strategy. Taxes aren't just about compliance, they're about efficiency. 8. Every dollar you save legally through smart planning is a dollar you can invest, grow, and use to create freedom. Year-round planning ensures that you're not just reacting, but actively shaping your financial future. Let's make this concrete. Imagine 2 people earn the same income in 2025. The first waits until tax season, files quickly, and shrugs off the bill. The second tracks expenses monthly, adjusts withholding mid-year, maximizes retirement contributions, harvests investment losses strategically, and takes advantage of every credit. Who do you think ends up with more money in their pocket? The second person, not because they earned more, but because they planned smarter. The bottom line is this: the new 2025 bill is just one change in a long line of changes to come. If you only react once a year, you'll always be behind. But if you adopt a year-round strategy, you'll not only save money today, you'll build habits that protect and grow your wealth for decades. Taxes don't have to be a burden. With planning, they become another tool in your arsenal.